Um, 19%. The CVARs, which doesn't seem too bad, is $1,800. The risk adjusted return on investment, which coincidentally is also 19%, and the volatility of P&L is plus or minus $1,000. Okay, so that's, 19% return for, that's your earnings season. All right, not bad. Let's go next slide. So we did the same study for consumer stocks, which have a much lower implied volatility, right? Like Nike, Amazon, Costco, they have a win rate is really solid, 73%. However, there were some big losses, specifically in Amazon. And when we did the whole thing over a period of time, because you can't just cherry pick, we found that the return on investment was very modest at 2%, showing that, you know what, these were tough stocks, not worth the risk. The volatility of P&L was 4,000. The volatility of P&L tech stocks was only 1,000. So the difference here is that you made a lot less money, you took a lot more risk, and it wasn't a great sector for risk return. Just, simply put, it just wasn't.
Yes, correct.
If you go to the next slide, now again, we're just trying to quantify risk. We're not trying to say this is easy or it can be done, in the future. This one here, we looked at entertainment stocks. We looked at, Netflix, Meta, I'm not sure I would call media, and AMC, throwing that in there. And the average win rate was a lot higher. The average the CVAR was lower, and the risk-adjusted return on capital was highest at 21%, and the volatility P&L was significantly lower at only $1,200. The media stocks, AMC, Netflix, and Meta, was probably the best of anything we've looked at so far, better than technology, and better than the consumer stocks by a long shot.
Yeah. Yeah.
And if you go to the next slide, John. So this one's interesting because we looked at automotive and we said, okay, well, how well did Tesla, Boeing, and Rivian do? Just trying to grab some stocks.
Now you're in the stocks we trade, right?
Yeah, we trade. We have positions on in Tesla, Boeing, and Rivian for sure. Rivian, we're smaller in there because it's only a $10 stock now, but over the last 8 years, it's been significantly higher. Tesla for the high risk tolerance and potential returns, Boeing for moderate risk with stable returns, and Rivian, for lower price, let's call it, lower risk investment. What's interesting here is that the CVAR was significantly higher. The volatility of P&L significantly higher. The win rate was about the same, and your return on investment was negative. So part of that's Tesla, part of that is, part of that's Tesla, part of that's Boeing, which had some big moves, but the risk return is negative. Before we go to the takeaways from the research team, let me give you just a few of my takeaways from this.
Okay.
I don't think you can look at any sector and say, going into the future, 5 or 8 years from now, 6 years from now, whatever, that this trend is going to continue. What I think is interesting is that there are multi-year sectors here which have done better than others, but generally speaking, the return on investment has been on earnings plays has been what I would call very marginal, meaning that 2 of them were basically, one was unchanged, one was negative, and 2 were in the 20% range. Given the risk that you're taking and given all what they called here the variability of these different things, there's not a lot of evidence here suggesting that for the risk you're taking, you got a huge reward.
That you get the bang for your buck, the whole volatility contraction, the whole enchilada of strategies moving very quickly in one day.
I kind of feel like there's nothing here that stands out to me that says, that these are great dues, and there's nothing here that says to me that they're not worth doing. I mean, they're an engagement tool, like we've said all along. They're fairly priced, they're random, they're an engagement tool. Let's see what the research team had to say. There was a tech semiconductor. Okay, I missed that. This is just an overview of all of them. And so you can see the win rates across the board, all in the same category. The max loss gets is pretty wide. The CVAR also pretty wide. And what's surprising is that before you looked at this, you would have guessed that the tech semiconductor space would have been the riskiest, and it turns out it was the least risky for the best return, and with the lowest volatility of P&L, which is really surprising. So in other words, you look at this and you're like, what I thought would be the riskiest was the least risky of the group. Let's go to the last slide.
Go figure, right?
Right. So in our previous study, we quantified stock price movements during earnings season and assessed the performance of defined versus undefined trading strategies. This study focused on quantifying the risks associated with the earnings announcements, which is essential for traders. Earnings season increases investment risk due to heightened volatility, especially in sectors that are more volatile. Stock movements depend on how earnings results compare to market expectations. To manage these risks, investors should diversify their portfolios, trade smaller positions, and use mental stops, I would say, when necessary. These stocks, the stocks analyzed, are examples of our backtesting tool, categorized by products and services they offer. You can also use this tool with different stocks to assess their risk, reward, and volatility. We've been spending a lot of research effort using our own tools because we want to show you what you can do with the technology that we've built. Again, to me,
you're talking about the backtesting tool now on the web of Tasty Trade, correct?
Yeah, but to me, these results show a lot of randomness, and they show risk where you didn't think there was risk. And if you go back one slide, John, to slide number 8 for a second, you can see here that, you would just think that consumer retail would be, I don't know, the most boring of all those groups, and
sure,
it had the most risk, and the tech would be the riskiest, and it had the least amount of risk. So it's not always as easy as it seems. I'll just leave it there.
Welcome to Theo Trade. This is Don Kaufman. It's October 25th. Choose.
There's a couple of different ways to look at profit targets, right? You can say you want to make 50% of the credit you receive, right? That's one way.
Yeah.
You can say, we're going to manage a 21 DTE, wherever it is. That's like one of the things we do, right?
Yep.
Those are, I wouldn't call either of those two dynamic. Those are kind of like static, right? You're either managing at 50% or you're managing at 21 DTE. But what if you just gave a little flexibility? Like, what if you made more money sooner? Like, you put a position on today and it actually worked.
Okay.
All right. That would be something. So if you want to take profits, let's say 25%, that would be dynamic, right?
Yeah, I got emails about this last night. Volatility's contracted. They caught a good volatility run here, and they're saying, hey, do I wait to 21 days or do I close stuff? So this is very timely.
Let's take a look at the first slide. So when it comes to option trading, management mechanics can make all the difference. This is one of the key takeaways that Tony and I have learned in the last couple of years, that the management mechanics make a big difference. At Tasty, we generally favor locking in profits, looking at the 50th, looking for 50% of the credit received for a short option position. But is this too rigid? That is a good question. A common scenario is a trade that makes a good profit, but shy of the 50% early in its lifespan. Should we capture 25% profit after 1 week, or should we hold out a bit longer? Let's explore the effects of adjusting our profit targets, looking for more profit from trades that stay on longer, be willing to take a quick buck when things go really early. That would be kind of the definition of dynamic. Let's go to the next slide. So 15 years worth of data, SPY, Qs, IWM, 30 Delta Strangles, 45 days to expiration, contrasted the results of several management techniques. Closing positions at 50% of max profit, waiting 1 week to avoid closing tiny winners immediately after opening them, and then closing positions if they reach a larger percentage of max profit, of the maximum profit percentage of the duration that had elapsed. So what all that means is, if you make money in a shorter period of time,
what does all that mean?
It means if you make if you don't get to 50%, but you make like a prorated, like you make 25%, instead of getting to 50% in 24 days, let's say you get to 25% in a week or 10 days. You take your profits. Okay, that's dynamic. And then there's closing positions at 21 days, win or lose. And then there's also leaving all the positions in through expiration. Okay, so there's 4 choices here: 21 days, expiration, dynamic, or 50%. All right, you good with that?
Okay. Yep.
Okay, no, I just want to make sure we're good. Okay, so let's go to the next slide. All right, so this is the SPY. Now, interesting. Remember the 4 columns: 50%, 79% of the time; dynamic 82, 21 days 75, and expiration 68. We're going to rule out expiration because we don't do that at all, right?
Sure. We're not going to hold to the end of the.
We are kind of the 21 days would be. I would say that we're between dynamic and 21 days. What would you say?
Agreed. Dynamic in 21 days.
Okay.
And a matter of fact, on my podcast, I'm more dynamic than I am 21 days. But sure.
Okay. I think I'm more 21 days, but it doesn't really matter. We're in kind of agreement. When you look at these numbers, 50% kind of is pretty good. The 21 days has the lowest CVAR, which is where we are. That's what we're trying to do, is reduce the risk. But so that's impressive. But none of these are supposed to be dramatically better than anything else. They're all supposed to just have their, like to give you some insight into what do you think is optimal.
Yep.
So for the SPY, I'm pretty happy with the 21 days that we do because of the low CVAR and the decent win percentage. If you're dynamic like the bat is, you're going to be fine with the higher win percentage, just less profits because you're managing early.
Yep.
And if you're waiting for the 50%, you can't complain about that either.
Yep.
And even expiration in this case worked. Let's go to the next one, John. So the next one's IWM. Now, the first thing you notice about IWM, it's a smaller product, all the numbers are going to be lower. The weird thing here is that the 21 DT here, the win percentage is a little lower, but the profits are higher. And the CVAR is lower. This one, 21 days in IWM, seems fine. But if you did the 50% and you did the dynamic, those are also fine. Like BAT would do dynamic here. 85% and $23 is better than 50%.
Sure.
With a lower CVAR.
Right. I just like ringing the register on the podcast trade just to show people that you can do this.
Yeah. I understand. Ringing the register.
And then you make your judgment from there. Maybe you don't have as many positions that I have on and you'd like to, hang in there a little bit longer. But at least our whole thing is about doing something actively. And sometimes doing something actively is doing nothing. But you're not just setting it and forgetting it. You're actively watching your portfolio, which is what I want people to do. I mean, so many people have investment advisors, or they just put things in funds. They don't even know the symbol to the funds that they're in, or what they have on, or if they're even mirroring the market. So I like you to watch. I want you to be active. That's what I'm trying to do. Look for opportunity.
Let's go to the next slide, which is the Qs. And in the Qs, it's weird because they've had such a big up move, that the P&L numbers are just not that good for strangles. But here, you'd be, again, the 21 days stands out as the lowest CVAR. But from a profitability standpoint and a win percentage, the 50% or the dynamic is, personally, after looking at these, you got to go dynamic or 21 DT. The 50% sounds good, but it's hard to know what that is after all the adjustments.
Beautiful.
Let's go to the next slide. So some of the takeaways: the dynamic management averaged closing trades with around 23 days to expiration for both SPY and IWM, while failing to outperform the 21 DT management. But for more volatile things like the Qs, being willing to rapidly capture modest profits resulted in closing trades with an average of 31 DT and improved your trade P&L. dynamic profits were a reasonable alternative to hard and fast 50% goals for the active trader who does not depend on limit orders, but only early management, win or lose, was a substantial safeguard against bad losers. You know, I think one of the things that the research team pointed out here is that you can see how close all of these results really are. And I would say that there isn't a clear winner, except holding to expiration doesn't really make a lot of sense for us. And the problem with 50% is that it's hard to tell what 50% is after you've made a bunch of adjustments. So managing the trades early and dynamically, or doing it at 21 days makes the most sense to me.
Well, we're getting into it, right? Broken wing butterflies, everything you need to know about them.
Okay, let's see what we got. Yeah, Brother Will. Hotep. Well, the think back is the on demand. Yeah. That's on demand. Yeah, I just call it. I remember they had think back, and the on demand is where you could do your charts and whatnot. You know, let me just double check because I have Thinkorswim on the other computer up. Let me see, because I think that's what it is, the on demand. God, I haven't used that in a long time. Let's see. I mean, it's been, oh man, I can't remember how long it's been since I used that. I think, let's just double check that. Because I know that the charts tool does the chart tool has the on demand where you could go through charting, and that's great for like technical analysis type stuff. But man, I have not used that in years. Like before pandemic, I used to use it quite a bit for for going through my my algorithm. I would use the on demand for that. But that's what I mean is you should be able to use that to see the prices in the past, to see what had happened in the past. And I don't have that on right now. But you could look at your option chain and everything else. It is a little convoluted. I mean, it's great in theory, but it is definitely convoluted, in terms of just getting into it. I mean, if you want to be a techie and do it, I say, definitely try it just to play around with it. But for me, I like to, I used to do that for like the Holy Grail trades. That gave me, the only problem that I couldn't do is look for open interest and volume. And that right then and there it nullified my reasons for getting into the Holy Grail trade. Because if I can't see volume or open interest, there's no reason to do it. I'm still trying just to see what our inventory is. Basically, I think markets are pretty flat. SPX is down. So it's basically down from where it was at yesterday. So it's basically this week so far is flat. SPX is flat. VIX is just, again, kind of like where it was at yesterday. VIX is, with the last 2 days is flat. Bonds. And I think and bonds are down again. Bonds keep going down and down and down. I mean, you've got some heavy duty numbers coming out this weekend or this week. Inflation, I think GDP and non-farm payrolls. I know you got some heavy numbers coming in this week. So I could see these 2 days being kind of flat in terms of, let me just double check because I could show you better than I can tell you. I can show you better than I can tell you what is happening in the next couple of days. Yeah, you got some heavy numbers coming in. Let's check it out. So therefore, without a doubt, I can see why there's not a lot of movement in terms of markets, because they're waiting. I mean, you got an election or a selection, as I like to say. You got that craziness, and the build up to that, and then because a lot of folks are going to be making positions on. I'm trying to get out of IWM because I don't want to be on during this selection because I've already made one roll. So I would like to take it off and redeploy. Therefore, I'm redeploying for the same expiration, just a different strike prices. But so here you have let's see, coming in today, consumer confident, you got the JOLTS job openings, and that's pretty heavy coming in today for United Snakes. You also got preliminary inventories, which is not super heavy, but it's going to kind of tell you where inventories are more than likely to happen. Tomorrow, which is I believe Wednesday, you have I know you got some heavy duty stuff coming in later on. Yeah, you got GDP price indexes, you got GDP tomorrow, and you got non-farm the ADP reports, and that should be pretty heavy for tomorrow. You also got crude coming in and pending home sales. Or no, that's you got crude and pending home sales, which should be you got advanced GDP. So tomorrow's going to be pretty heavy. So I think, I'm not saying today is going to be totally not moving a lot, because anything can happen. But I'm pretty sure folks are keeping their powder dry just in case. And then you've got Thursday, Halloween. You've got core CPI or price index, excuse me, not CPI. Core PCE is coming in, and you've also got the unemployment claims coming in tomorrow. So you got ADP unemployment claims, and then you have for Friday, or no, that's not Friday. Then you have Friday, which is the biggie that all Forex traders know, and that would be non-farm payrolls and all the employment stuff. So you've got some heavy duty numbers that are here. You've also got PMI Friday. So there's some nice heavy duty things coming in this week, which I could see why, if it doesn't move so much today, I could see why that folks are kind of taking kind of a wait and see position before they start either deploying new capital. Me, I'm just kind of like, some of these strangles that I have that are I'm just reevaluating. The deltas are extremely neutral, which I expect because of the fact that, of course, I don't expect a lot of market movement today. So the deltas are pretty neutral. But the thing is I don't want to be in, wait a minute, let's get rid of that. Let me just share back to the thing I wanted to share, which is this. And I'm trying to get out of IWM, but we'll see if there's some trades that we can get in. Any trades we can get in. Good, I'm out. Now I can redeploy the capital. I know Tasty Trade loves their commissions. They got to start filling me with commissions, so that way they could so that way I could trade, man. You can't trade if it ain't gonna fill you. Let me give you commissions. Don't not fill me. I'm being facetious. But so the thing is that IWM, I want to redeploy that IWM trade, and we're gonna redo that for December. Because I got out basically at a what did I get in for? We'll see it in a minute. I know it's basically a scratch. The IWM was basically a scratch on that. Maybe a little bit down. We'll double check and see. But I don't want to be in that trade because of. So let's see, IWM. What did I do on that? So 172 credit with 46. That would be 8. That would be, let's see, 8, 1, 2. So basically, it's a scratch. That was basically 0 for which I don't mind, minus the commissions, because I want to redeploy this better than I had before because of the fact that it had that I moved it around so much. I just don't want to be in something that after I've rolled it once, I don't want to be in that particular trade during an election season after I've already rolled it. And I think I had, was it $5 or $10 strikes? They were $5 strikes. Okay, cool. I want to see the granularity, which means Normally you have 5, 10, 15, 20. Well, the granularity here is 5, 4, 3, 2, 1. So the strikes have a lot of better granularity. That helps me in terms of when I want to move it. If I want to move it one strike at a time instead of $5 strikes, it kind of helps me. And, and that's what I like, because there's a lot of liquidity. You have good granularity in there. Whereas here on the upside, you don't. There's not a lot of granularity on the upside. It's $5 strikes. And what did I have here? I have the 205, 240. And what did I have before when I started out? I had the 230, 235. So that meant I rolled up my puts. So 235, 240, or 240, 245. So everything kind of shifted to the upside because of the fact that IWM was definitely, I'm trying to think when that popped, the market popped up there that forced me to go ahead and change my deltas. But I don't mind that. So let's take a look at this to redeploy that. Again, this is part of the inventory because I do like this. Here you got IWM, which if we look at it, let's look at it, the tradable statistics on it. If we look at, let's go to ETFs because that's a lot easier. Liquidity, high liquid ETFs. We should see IWM in here. No, it's not in there, but it is liquid. It's just not in there. Or is it? Yeah, there it is. Lot of volume on there. We still have 42 for our IV rank, 28 for our index, and it's been going up in volatility just a tiny bit. So it's still tradable. It's still tradable. The thing I want to look at is the hill. Again, how far away from this so if this hit our short strike the next day, we'd be down. If we're getting 147, our buying power is 51. We're only down like 1/6 of our buying power on the downside if this thing should rock us out of the position. On the upside, we'd be down. And again, a lot of that is, it's about protection. We'd be down a little bit more. If it rockets to the upside, we'd be down about 1/3 of our buying power, which I don't like. I don't like being that much down if it should rocket to one side or the other. It's pretty much delta neutral, no gamma problems. 59% chance, which is not incredibly great, of getting of making a penny or more. And I think a lot of that is because of the this quote unquote election. We are getting paid $1.78. We have a 77% chance of making 50%. And so if I put this one on, the last time I put this on, what was my credit? 172. So I had a lot more credit last time when I put this on. This time I'm getting a little bit less credit. I'm getting half, about a little less than half. Last time I think I had actually gotten half. That's what, again, this, you want it to be 1/3 the width of the strikes. This is much more than 1/3. So I really like the credit, but it's not great. Not as great as I had before. But I don't mind that. That's probably why we're getting more on the hill, i.e., we're getting a little bit more steep. We got a little bit more risk to the upside. They're skewed to the upside. So I'm not going to trip. But if we're close to delta neutral, so I'm going to go ahead and see if I can get this on at $1.50. See if I can get that filled. And I'm going to see if the market will come up to me. And if it does, then, and if not, I'll just back it a penny. Again, I want to see if the market will come up to me and not go down. I want that market to come up to me. So we got that on for 150. It's $1.48. And if it looks like it's not going to come up in the next in the next hour or so, I'll back it down to 149 and see if I can get filled. So we'll see, we'll see if we get filled on that, if Tasty Trade wants its commissions. And I know they do. Tastyworks wants commissions, so they're going to have to fill my trade. We don't have anything major in the deltas. Again, markets are just kind of flat, so there's no real major on our deltas, which is this first line right here. The deltas aren't moving like crazy where I'm seeing -15 or +15 on strangles or anything else. So I think things are kind of sanguine until you get these numbers coming in this week. You got earnings and you've got heavy duty numbers coming in all week. So, and when you ask about selling or about buying volatility, the one I have right here, EEM, is buying volatility. That's the one that I'm buying volatility in terms of, it's a calendar spread. I think it's a double calendar. Is it a double calendar or double diagonal? 47.43, 47.43. It's a double calendar. selling the 47 call, buying the 47 in December, selling the 43 put in November, and buying the 43 or 47. 43 put in December. So it's a double calendar spread, and so therefore I am buying volatility as long as the market stays in between those, because I am getting paid $1.69 in theta every day this thing is on. Anytime I trade, Brother Will, I'm always thinking of theta, making money every day. Even if my deltas are off, I want to make sure that I'm at least getting paid a little bit per day that the trade is on. Every day that trade is on, you're making just a little bit more. And that's what it is. My thing is just to see the front month theta, the November contracts expire before the December contracts. And that's what you want when you're buying volatility. You're selling the front month. It's like milk in a store. Okay. It's almost like you're selling milk. The front milk is the milk that you want to expire. The back milk has to stay for a little while. And that's all it is. When I'm doing calendar trades, the one I was looking at, I think that I was trying to put on before, was a calendar on spiders. And I said, and the TLT butterfly. And those are the ones that didn't get filled, but I really want to get that spider filled. The only thing is again, you've got volatility this week. And if you're non-directional, this thing could go. It's better to be directional when things are crazy, because then you can define your risk a little better than a crapshoot. You could define your risk in terms of, okay, I only want to lose this much, because if it goes down against me or goes up against me, I know that, hey, I just gave it a crapshoot. But if it goes for you, you're going to make more when that thing goes in your direction than when you lose. Whereas you're doing something that's non-directional, like, double calendars, iron condors, strangles, double diagonal, stuff like that, which there's no direction. It's going to more than likely be a little bit more difficult to manage that trade, because, it's going to go against you. I shouldn't say difficult, because you can manage things that go out of bounds, but it's just that risk-wise, you might end up, I've just noticed this overall, that when it's a super volatile situation, I like to go more directional, where I'm buying volatility. So if it goes against me, I'm spending a tiny bit of money for it to go against me. Then having something that's non-directional, I'm getting a lot of credit for, but then the risk is higher. Again, the mountain is way, way away from where the risk, where my profits are at. So I'm paying more for the risk in the mountain than what I'm getting for whatever I'm selling, whether it's calendars, diagonals, stuff like that. So I tend to see that more often. And so that's what I'm kind of playing on this. So anyways, the two trades that didn't get filled, one was TLT. And I think this is the last day to see if we could get this filled. Let's just see where TLT's at. Bonds are falling again. Actually, they fell 52 cents. So let's strike this one up. I was trying to get 12 cents. Credit is still only 11 cents. So even though it fell, you're not getting a lot of money. Normally when it falls, in a butterfly that's going down, you should be getting more money for that butterfly as it falls. And the butterfly looks like a butterfly. It's a triangle, the triangle trade. That's the thing that I noticed. This thing has been falling, TLT's been falling, but yet the credit has not been going up. You're only getting 20 cents of theta a day. But I've noticed that. I'm like, because the thing is you want this thing to either stay where it's at, go up, or not fall too far. And that's what I noticed. If we look at TLT on a chart, look at what's been happening. It's been falling. And it felt pretty good yesterday, so you're not getting paid for that fall, because the closer it gets to the butterfly, the more you should be getting paid in terms of credit. If we look at the volatility, or let's look at the metric of where TLT is at in terms of, let's see, is it on the chart? It's not even on the chart of high volatility trades. No, oh yeah, it is. It's at the top. Yeah, okay, IV rank high. It's still going, so basically it's staying volatile. The volatility it should give us, we should be getting filled on that. But we're not getting filled for the fact that even though it's falling kind of closer, the closer it gets to here, the more you should be getting filled. But it seems to not want to get filled. But you know what? I'm going to keep it at 12 cents. And I want to get in. I really want this trade. I'm not going to back down. I'm going to stand my ground on this trade. And that's a broken wing butterfly. Only because I have a feeling that it's going to pin. No, I shouldn't say I have a feeling. I've been working on something to see that this thing is going to pin, which means you're literally, spending 88 cents to make $1.12. I have a feeling that this thing's going to pin at 87 at expiration, which is, I believe, this is December. That I believe that I've been working on something on this to say that at 87 you'll see TLT hit and pin at market close. It may not, but I'm working on something to see. Okay, maybe this, and it's part of something that I showed you a little bit of. I barely showed you when you came out to visit. I barely showed you this. And a lot of that had to do with the action reaction analysis and cyclical analysis. My sister and I did a live stream because she's my ears and my eyes. When my eyes fail, she's going to take the mantle and kind of keep everything in kind of an archive. Once everything is gone and I can't, see a chart anymore, she's going to keep it in the archives. And we did this live, Brother Will, Sunday, and we were doing it when it was illiquid futures market. And I was showing her, I said, now look at this. And as we're watching it, the market is turning at my points. And I told her, I said, now you see why I'm scared, because this is something that, and I showed you the whole thing about Marischal and all that. I could go back through that, but I showed her and I said, look, what I'm doing is what is called the impossible. Tasty Trade would say there's no way on earth this could ever happen. I like when people say things that what I'm doing is impossible, because that means that I know what I'm doing is working. What I'm doing is pretty frighteningly, is what everybody's been seeking to have, but hasn't attained in since 1930. I love it. In 1935. 1935, yes. I love it. When folks say it's impossible, I'm the one that bring the impossible out. But I just, that's why I like this business, because it's, it's not easy. It's just, hey, this is what it is. Now, anyways, let's go to that SPY trade, because I think I was I was going to do it, but I didn't get into it. But I'm going to show you how I'd set it up. Again, we could do it on the SPX, but the SPX is a very expensive security. The good thing about it is you don't get assigned, and I don't like getting assigned I got assigned spiders a couple of times on trades that I got assigned on Facebook when the whole market crashed on Facebook back several years ago. That's why I stopped trading Facebook, and I traded it during earnings. And the markets blew through my puts, and there was no way it didn't come back for months. There was no way it was going to come back. And, I was just like, hey, this is a losing trade. Boom, let me just walk away from it and let it just expire worthless. But I don't like getting assigned, because when I got assigned, I was like, because there's nothing I can do. It was just so far out that, it was a black swan, or what they call the conditional value of risk is a worst case scenario of how much you're going to pay. And it hit the worst case scenario because it was a defined risk, thank God. But that's what CBAR is worst case scenario, which only happens like on the outer tails of the standard deviation. It only happens like 5% of the time. What's the worst case scenario that could really happen 5% of the time? What are you about to lose? And that black swan. And that's what I'm always looking at. What is the CBAR? What is the bad? Because if you can manage the bad, hopefully the good will happen for you. And that's what I've been looking at in terms of some of these. So we went through market, we went through inventory. Hey, KW, good to see you. Always good to see you. We went through markets, we went through inventory. Now we're going to see if there's opportunity for buying volatility. There are two different ways to buy volatility. One, they like to trade VIX futures. Okay, we could do it through VIX futures, or we could do it through the VIX itself. Now I've been doing pretty good just trading VIX, but we can do it through VIX futures. Okay, through this contract that's here. Okay, and the thing is if we were to do VIX futures, and we were looking at the no, we can't do what I'm doing. I was going to buy VIX futures, but I don't want to see again. If I was going to look. I was looking at options. If I were to buy VIX futures, I would buy the thing is I would buy the VIX future and then hedge it off with VIX options on the VIX itself. But the thing is, that could get, I'm going to show you something that could get convoluted. It might be it might take some buying power, and that would be a different session for you, how I would use futures, a VIX futures, and hedge it off. You look at the VIX futures and then hedge it off with whatever VIX futures are at. Hedge that off. I would look at the options. You know, it's like I said. See. Let me see if I could do that, because I could, I could actually, because I had it before, where I think it was the futures, or no, it was S&P futures hedged off with, it was S&P futures that was hedged off with VIX, the VIX, because I was looking at the VIX futures, but I was hedging it off with VIX. Let's see if I could do that, because it was a really cool thing. You know, it was a really, really cool thing that I worked on. And I was wondering if it was hedging the futures out with with the VIX itself. I mean, I'm gonna have to go through that, but it was a really cool thing that I was doing. But just to make things easier, we'll go with VIX. Okay, buying volatility. If you think volatility is going up, which I do, I think it's going to go up. And here's the kicker: if we're looking at this, I don't think it's going to, like, if we look at this, of course, the volatility is going to be huge because of this so-called election. I would look at, let's go to E-mini futures, or E-mini, the E-mini ES, and let's look at where they're looking at. So they're looking at a spike in volatility right before that election. And here's what's funny, is a lot of folks are saying it's a non-issue, but if you go to the November 5th, up to November 5th, November 1st is where that spike is up. But November, you have a spike, you have 19% volatility there with a $77 move, okay, on VIX. And that's November 1st. The day going into the election, you've got 16%, which is lower volatility, 2-3 points lower, but a 90% move. So they might be looking at this to be a majorly non-issue, except for November 7th might be the fallout, which is 9 days from now. November 7th they're looking, because maybe it's post that they're looking at, not leading to the election, but post-election, they're looking at $175, damn near $200 move the week. Maybe it's because, let me put on our geopolitical thinking hat there, brother Will. Let me think, KW. Let's put on our geopolitical thinking caps. Why do you guys think that 2 weeks out of their so-called election, that, remember, the week of the election, of their U.S. election, the week of their election, you have 99, at the very most, anywhere from a $77 to an $85 move at that election. But 2 weeks out, even into more than 2 weeks out, I'd say at least going 2 weeks out of their so-called election, more than 2 weeks, you're up to like $217 moves. Now, of course, everybody could say that's because that's natural for, markets to have more premium as you go out in time. That's contango. That makes sense. But let me tell you what I'm thinking. Why do you guys think that that's going to happen? Put on your geopolitical hat and tell me what you think. Why do you think that they're pricing markets moving crazy after election, but to the point of 3 times the amount of market move because of an election? Remember, up to that election, November 5th, they're only pricing in 75 cents or $75. 2 weeks, 3 weeks later, they're pricing in 3 times that amount of movement and then some. Tell me what you think. I'll tell you why. I'll tell you exactly why. I'll tell you exactly what they're doing. I mean, put on your thinking hat. Think about it. Why do you think it's going to happen? I'll just keep you guys hanging for a minute, and then we'll come back to it. I'll leave you hanging. But anyways, knowing that that's the case, that they're pricing in 3 times the movement, then therefore, chances are, if I buy volatility, I might be able to buy it looking at expiring just after that particular situation. Okay, going into maybe December, maybe even into January. Look at that, February. They're looking at $300. Again, contango, of course, because of the further out, the more movement. But we're talking in the case of 2 or 3 weeks that you're having 3 times the movement. And then after that, it's just off the hook in terms of the movement, market movement. You're talking, they're pricing in 300-point movements. Of course, the further out in time, that's going to happen. But the thing that gets me is why 2 weeks and 3 weeks, all of a sudden, it's like a jump. It's like it goes from like 90 and all of a sudden it's $200 move. Double it, like the next expiration. Think about it. In the meantime, let's go back to VIX in terms of buying volatility. Buying volatility, the thing I'm going to look at is I would like to go out maybe into January. They're looking at $5 moves, no more than like $6. So this is not moving like it's like $4. It goes up by 20% here. Then it goes by 1/5 up to here, close to. Okay. So you are seeing the moves out into that November and whatnot, but then it backs down going into January. So I would love to see, chances are they're expecting something to go really crazy up into January. Because look at this. The expected move, the move of $5, or basically it's $5, 5.25 or 3/4, $6, and it ranges, going in until it's $7. But that's not as huge. I mean, you're going from $4 to $5, basically. The volatility is up. Why? Why do you think they're thinking that it's going to get pretty volatile? So I'll go out into January, see if there's any volume. It's not really any volume there. Oh, darn. See, December, well, remember you got triple witching in December. You got all that happening in December. So you got a lot of contracts that are happening. And this is VIX. This is VIX. And when VIX goes up, things go volatile, and that's when they think markets crash. When VIX goes down, they think that markets aren't going to crash. Put on your thinking hat. Why do you think that this thing they're pricing it to go up? In other words, I'm fixing to make a trade. Check this out. And this is why I like Theo Trade, because Brandon is really good at Theo Trade. But I'm thinking, man, I'm thinking of our other good brother, but that guy, he's not a brother, but that guy is so good at being able to look at options and open interest and be able to predict where the price is going to go. Just think about it. How to predict where the price is going to go. And then we're into December. This is December 18th. Let's see if we could go out. No, we can't. We can only go out to January, but there was not enough strikes. Not enough, there's not enough contracts. So we can go into December. So somebody's expecting a lot of craziness right after that election going into December. Why do you think? I'll tell you I know exactly why. So anyways, if I were to buy volatility thinking that this market can go up, you've got 126 contracts here at the money, at the 20, and 126,000 here and 231,000 here. That means that these things, this is a spread. That means that somebody wants this thing to go to 23, the VIX to go to 23 sometime in December. If we go out, which is 1, 2, 3, 4, 5, 4 strikes out. If we go 4 strikes down, thinking that the market's going to go down, 1, 2, 3, 4, you've only got 210 strikes. You do have 5,000 strikes, but that's nothing. Somebody thinks this market's going to go up to the upside sometime in January. Somebody think this thing is going to go ballistic. Now, before I put on this trade, I'll tell you why in a minute. Not only do you have this, how many open interests? Remember, open interest is the uncle to volume. Look at how many people are holding under these contracts. 181,000, 86,000. I mean, it's somebody believes that something's about to happen. If we go out 1, 2, 3, 4, 5, 6 strikes, that's 86. 1, 2, 3, 4, 5, 6. So that's 80. That's 65. So somebody believes that this thing is going to go through the roof. But there was a lot of contracts bought here, and bought at the money, and then 4 strikes out, which somebody's holding 11,000 there. I think it was 4 strikes out. Let's double check. Let's go to volume. Yeah, and that's 2.30. That's two. Wait a minute. I said 100. Yeah. I said 140. I mean 1.41K. Yeah, that's 140, right? No, that's 1,000. Excuse me, 1,000 contracts. I'm thinking somebody is believing that something's going to happen. Here you have at the money. There's almost nothing. You could go out 3 strikes, and then somebody believes this market will fall to 17. And so, because you've got a lot of contracts there. In terms of how many people are holding it, you got 151,000. So there's a lot of folks holding those contracts, but this is the spread right there. I don't see the spread on the puts. Maybe, check this out, somebody is probably selling puts to finance because I don't see the spread. I don't see the protection there. And you can't buy the VIX like you can buy, because it's an index. So chances are somebody's probably selling these puts down here, 510 contracts that they're holding or that are being traded, selling these puts to buy something up here because this is going to cost you. Buying this spread is going to cost you. So somebody must believe that this market is going to be beyond 23 in December in terms of VIX. Again, we're buying it this time. You're getting paid 15 cents a day, which is telling you you're making money per day. And so, so you're not losing money because this is paying you more than the 140,000. If we look at implied volatility, that's probability of touch. And I told you about that before. Okay, actually, no. Yeah, this is 115% implied volatility. This is only 102. That's why you're getting paid 15 cents a day. 3 strikes out from at the money, 1, 2, 3 is 115% implied volatility. 3 strikes out, 1, 2, 3. Let's see, you're only at 86. So somebody believes this market's going to, in other words, if we look at the mountain, there's skew going to the upside. There's a lot of skew to the upside. Somebody believes that this thing is going to move to the upside, and it may never do it. Kamala Harris might be your new president, and everybody thinks that it's all good and we're back to square zero. Who knows? But all I know is when I see theta like this, that means somebody believes this thing's going up. Let's look at the chart. VIX is still kind of low. It's at, it's at 19. What's gone up since yesterday? But it's been ranging. It's not spiked yet. Somebody is looking at a possibility of this going up. I have to buy this volatility. It's only 47 cents. And when I say 47 cents, how much can you make? You're spending 47 cents to make $253. I'm just going to make this trade, even though it's only 47 cents, and it may be a loser. I'll get out after 20 at a 50%, but I got to make this trade. Why do I got to buy this volatility, this losing trade? Because it could be a loser. If we look at the curve, remember the mountain curve. Okay, if we go down from where we're at, we go down from 20 to 18. Let's just do this and because I really want this trade. So if we go from 20 to 18, let's say around the 18, it'll go to 20 to 17. We'd be down pretty much $10 theoretically. If we go to 20 to 23, we'd be up $54. So that's just the theoretical. That's just the mountain. Okay. So we go from 20 to 23. We'd even be up more than that. If we go $3 up, we'd be up $60. If we go $3 down, we'd be down only $6 or $7. No, we'd be down $10 or $11. I don't mind this trade. But why do you think folks are looking at upside markets? I really want to get into this. So we're gonna work this. Where's VIX? 47. I don't mind hurting myself and going above the market on this because I want to get in this. I want this. Cool. I want that trade. I went and paid more for that than the mid of the price. Why? Because I want this trade. It might not be the best trade, but I want it nonetheless. I want it because it is a trade that, irrespective, if this thing moves against me, if this thing moves up again to $23, I can make about $60 if it moves $3 up. That's a big move for VIX. Because if we look at the chart of VIX, VIX does not move that much. Oh, no, it does. It can move $1. It can move $4. In the last 21 days, it has the propensity to move $4 either way. Okay, which is cool. Okay, I don't mind that. Okay, if it has that propensity to do that, I don't mind that a bit. Because if this thing moved $4 up, we'd definitely be in Money Monday, and that's the theoretical price. That's that price on that day. We're getting paid 15 cents a day, or 14 cents, because I paid a little bit more for the for maybe even under that, maybe 12 cents a day, which I don't mind. in terms of theta. At least I'm making money theta and not losing it. But why do you think? Why do you think? Again, the skew is up to the upside, which means that the more it moves up, the more you make. Then when it goes down against you, and the more you lose. Why do you think that 2 weeks out? That's buying volatility. I'm buying volatility, but making theta. Why do you think? I gave you guys 15 minutes to figure out why you think that's the case, and nobody answered. Nobody answered. Why you think that I might just have to leave you guys hanging, because I know exactly why I know exactly why they did that. But that's buying volatility, so I have to take that trade. That's a no-brainer right there. That's a no-brainer in terms of why it is. So I'll leave you guys hanging, but I know exactly why that is. It makes all the sense in the world. Why not on the day around their elections, but 2 weeks after? Why they would be more prone to getting buck wild in terms of volatility. I love this. What is the VIX? VIX cost me 48 cents. Man, I don't mind that. I don't mind that at all. 48 cents for this trade. It could go against me. Chances are it will, because every time I get into a trade, the first thing I know is it's going to go against me. I never get into a trade thinking, oh, this is going to be a winner. It's got to be. I get in knowing full well. And the VIX, I'm 10 deltas long, so I don't mind. I'm 10 deltas long. This thing can fall up to $13 and I'd lose it all. It is what it is. It's only 48 cents. But I know why. I know exactly why. So that's buying volatility. I'll give you one other example before we conclude, and I'll let you think about it for the next week. Why? I know exactly why this is happening. That's why I had to take that trade. So let me get into SPX. And when I look at buying volatility, again, I could look for volatility to sell, but chances are we're going to be in the same situation as yesterday, because markets are not really moving too much. SPX is only down 45 cents. VIX is probably, I know it's pulled in from where it was at before. It's only, VIX is down 11 cents. So it pulled in a little bit from where it was at before. In other words, I'm losing 11 cents since I pulled the trade up. No worries. But if we look at our list, I'm looking at like stocks and other things. I don't want to be in stocks before non-farm payrolls. The ETFs, I don't mind as much. I already got metals on. Financials and energy were the only other things I don't really have a lot on. I could get into XLE. Problem is, even though volatility is high, it fell more than 4% in the last 5 days, especially after we looked at it yesterday. I could get into XOP, which is energy, and I don't mind this. 47, 44, 31, and it's gone up 0.8%. It is a very expensive, so I would have to do that as a iron condor. Let me see what is financials. XLF. See, XLF is not on our list of high. Let's see. It is. No, it's not on our list. XLF. But I wanted to get into energy. I would get into USO, but I don't see USO on the list either, on the liquidity list. XLF. XLF does. In terms of. Let me go into high options volume, because that's better. I don't see XLF, or do I? Should be in here. XBI is in here, but I don't think you're going to see a lot of liquidity on that. Ford, I think Ford just had earnings. You're going to see a lot of liquidity on that. And I don't mind trading Ford. I know Ford just had earnings, and I think they did good. I think they did good on their earnings. Oops, quote details. There we go. Quote details. Yeah, they had their earnings. And I think, let's look at Ford's chart, because we could actually tell in their chart. Yeah, Ford actually, yeah. So this is, even though it had earnings, let's look at the volatility rank is still 37. It's not incredible, but it's still good. Volatility rank of 37. Look at how much Ford fell today. Even though I think that they beat earnings, it still fell on them. Has 60 cents, it moves in the last, 60 cents a day is the average that it moves in the last 21 days. Today alone, it's already fallen 93 cents. So 1/3 more than what it normally, so 133%, 233, percent of my analysis that this thing, because I'm using 60, so it's 133% of what I think. Then from the 33%, then I think it'll move. But anyways, so I'm looking at this, saying, okay, Ford, what do you got? You got it? Is it tradable? Can I again? I have to start everything with a strangle. December strangles. And the only thing that would keep me out again is the liquidity. Number one, there are a lot of strikes. Look at December. There's a lot of liquidity in this. The only thing that would keep me out of this, it is a very low price stock. We're going at the 14 deltas. Let's go 14 deltas. The only thing that would stop me is the fact that that's a rival to Elon Musk. And I think Elon Musk they're trying to push him buying Ford. I don't think they would let that happen. But it's a rival to Elon Musk. Elon Musk is the big, he's the big dick on campus because of Tesla, and that's a major rival to Tesla. Here's the thing: the reason I wouldn't do this is you're only getting 19 cents on $2 of buying power. 19-cent credit. It's a low price stock. Of course, you would get that. So I couldn't see doing this in terms of a trade. I always look at the strangle to see what is the pricing. And even though, even though you got a 99% chance that this thing is going to get you paid, at least 50%, that's nothing. That's not even commissions. You're not really making money on this. But I look at this and I say, well, what kind of trade could I do? I love selling volatility. It's still kind of volatile. What could I do? I could sell puts. That's where most of the puts were most of the money of what you would be making. I could sell maybe, several contracts of puts to finance maybe a call spread. They call that a jade lizard. So therefore, there's no risk to the upside and only risk to the downside. So I could sell this, and what would that look like? What would that look like? It's not a classic, but it is what they would call the jade lizard. So you shouldn't have any risk to the upside. I would never, I couldn't do this. There's risk to the upside. I couldn't do this because let's see if you would lose $4 to the upside. If I did this, I would put instead of the 9 put. See, we go to the 950. We're right there. We're basically, this is not a tradable thing, but I'm just kind of looking at it to say, what if? Because you're right there, damn near in the money. If you look at the mountain, this thing is already off the side of the mountain. If I think this thing, I would like to sell volatility, but I wouldn't want to buy it. I could do a ratio spread, but again, if I did a ratio, whereas if I think this thing will spike, I'm not looking at this thing to shoot up to the upside anytime soon. They have to digest what happened. So I wouldn't do like a ratio spread where I would be, they call this thing the valley of death, where you're literally, it's a really scary trade. Let's take a look at it. It's if I think this thing is going to jet to the upside. If I think it's going to jet to the upside, which I don't anticipate, it would have to jet to the upside pretty fast, like very fast. If I were to do that kind of a trade, let's see, if I did this, no, because I'm just trying to see, to try to price it. Yeah, it's not going to happen. It's not going to happen because I was going to try to sell 2 to buy 1, and You know, I know it's not gonna happen. But I was just looking at that just to see. I was. Oh no, I might leave you hanging. You gotta do your mindset. You do your mindset to think about it. Think about why. Think about why would that happen. Okay. Think why would they, it's it's like think about why they would do that. Why would they do that? Why do you think that they would literally be that they would literally like 2 weeks out, it would be ridiculous. It'd be ridiculous in terms of why they're looking at that market, for lack of a better term, that they're looking at that market doing what it is. 2 weeks out. I was looking at the zebra trade, zero extrinsic, but then I was looking at a ratio spread, and I was thinking about a ratio spread on this. If I thought this thing would go to the upside, be unlimited. Okay, there we go. That's why. If I thought this would be unlimited, do I think that, let's see, if I thought this thing would go unlimited to the upside, how would it, again, a lot of this is, if I did this and I thought this thing was going to be like through the roof, I'm just trying to think. If I thought this thing was going to go through the roof and I did the 10-11 ratio spread, I'd be in the money by the end of the money. The problem is I would have to do this a little bit out of the money in order to do this. Problem is the valley of death. I mean, it's a $77 valley of death, but it would have to like move within, between now and December. This thing would have to move like crazy, because the longer it hangs out, the more money you lose. And I think they're going to digest Ford's earnings before it moves up. But if it explodes, and even if it gets in the valley of death real soon, you're not going to be making a lot of money anyways. That's if you want to buy. You're only getting 3 cents of credit, which means your risk is only 3. So it's not really worth it. I was just looking to see if there, I mean, I could sell puts on it, but you're not getting any credit. I'm just thinking of something that if I believe that this thing, because volatility still is not like, you're not getting a lot of money for it. Nah, I was just, it's a gamble. It's a gamble. I was just looking at seeing if I could gamble with this, but no, I wouldn't do that. That's too much. I mean, I was looking at saying, okay, do I want to spend 77 cents to gamble? Nah, not really. I mean, yeah, Brother Will, think about it. Think about it for a minute. Why do you think that 2 weeks out, between the end of their elections into December, that they're pricing markets to either fall or move like 300%? And it's very logical when you think about it. And that's why I put on that VIX trade. I'm glad I got filled, even though I think it's going against me. I think it's going against me. Yeah, it's going against me by $1. I don't care, because I want that trade. I want it. Anytime I wanted the VIX trades, it's always gone in my favor. Anytime that I wanted it, I've always been able to. I mean, VIX has been really good for me this year in terms of timing when to trade VIX. It's been really, really good for me. And I want that trade. But you think about it, I'll come back, I'll do another live stream. If this, whether it goes good or bad or other, I'll do another live stream. And then you'll know exactly what I mean. You'll be like, now I see why he did it. Even if if their markets don't move for me and it moves against me, at least you'll know why I did it. Let's see, anything else that we can sell? See, a lot of these stocks I don't want to do because of the fact that I don't like selling premium when things could get really ridiculous. Um, and I'm looking at the 5-day volatility. Has it been going up or down? Anything that I sell has to go up in volatility. Look at Tesla. Tesla is definitely, I would have to do a spread because it is priced in there. Bitcoin, look at that. BITO, 9% volatility. Look, I mean, I haven't really traded BITO or any of that, the Bitcoin in terms of like options on it, because let's take a look at their options and you'll see what I mean. It's like DJT. I think it's better than DJT, but look at that. 60-71%. I love this. But this thing, if we look at a chart of the BITO, I mean, it's been pretty cool, but look at that, how wide that range is. I mean, it's pretty wild. It's pretty wild. It has the potential to move at least $2 a day. $2 in the last 21 days is the average. Again, I always double it, which is 10% of the stock price. So, it has, right now it's moving at like 5% of the stock price. This thing could easily move, like I said, I always double it on the ATR. And I've rounded up. So if I double it and rounded it up, I'd say $2 that this thing can move at any given point. So I'm giving it 10% of the stock price on BITO. So that, and the volatility is up without a doubt. Why? Because Bitcoin is ridiculous. You don't know where it's going to go or why. So it makes sense. If I wanted to put this on and I did the 16 deltas, you're going to definitely find skew to the upside because that's just Bitcoin in general. Has an upside skew. A lot of contracts there for BITO. To the upside, there's really a good amount of contracts, but you're going to see skew to the upside. Why? Because, actually, it's downside skew. Look at that downside skew. I thought it was upside. Look at the downside skew on that. It's ridiculous. If this thing fell, maybe it's just because it's so high priced. Everyone's expecting this thing to fall. Look at the skew, 165. So you would be losing 1/4 of your buying power. You're only getting 89 cents of credit on $5 of buying power, which is literally nothing for me. I couldn't take that kind of trade. But look at the skew to the downside. I mean, it's insane. Upside skew, if it shot up to there tomorrow, you would be getting, you would be losing like just basically, what is that? 1/5? Less than 1/5 of your buying power. But if it shot to the downside, you'd be losing damn near 1/4 of your buying power. Just because of the fact, and I mean, I'm looking at the theoretical, the mountain. Look at how the mountain is just totally, maybe, I wonder if it's just because I'm at 16 deltas on both, I think. I may be wrong. Hold on. Am I on 16 deltas? 16 deltas here? 16 deltas here. Yeah, the skew is just ridiculous. You don't even see the skew in terms of strikes. Normally you would see the skew in strikes. When this skews like that, the strikes give you a lot further out that you can place your strikes than your deltas. And, because it's only, look at it's delta neutral right there. But when you see the skew in terms of, let's check it out volatility wise. Where's the implied vols? To the upside, implied vols. Look at that. One strike away from the expected move, you're like 39, 40, 42, 45, 49, maybe 50. Downside, look at the volatility, 94%. So they expect this thing to fall. I guess there's a lot of money being put on Bitcoin falling maybe after their election. Again, risk falling. In other words, somebody's thinking that these markets are going to fall. You got S&P falling, you've got VIX rising, and you've got speculation called Bitcoin falling. Let's go to the price of money. Bonds. Let's go to TLT. We might be able to see it in the bonds better than TLT, but let's see where the expected move is on this. I already got the trade on December. Implied volatility, 1919. So it's not really as bad in bonds as it is elsewhere. Like 1% difference in terms of skew. So it's not as bad on that. Let's go to the ZB, $/ZB, and see if we see it there. 19, 18. So we're not seeing the cost of money freak out. We're just seeing speculation and fear freak out. Like somebody's thinking that market's going to crash right after their elections. I'm going to leave you guys hanging. I'm going to let you think about it because I could tell you the solution. I'm going to let you think about it. I'm just like, wow, that is very interesting. Not to say it's going to happen, but I really like that. I really like that kind of, because sentiment sometimes can predict something. It could sometimes predict what may happen next. And I have a really strong feeling I know why. I'm almost absolutely sure I know why. And I'm going to play it. I already played my VIX. It's not a guarantee, but I have a feeling. I know exactly why they're pricing in the craziness right after the election now and not before. Normally you would see it priced in before, but now it's after. Interesting. Anyways, if I wanted to get volatile, see, I would put a trade on Friday for next Friday because I would like to, do a trade that maybe if you see something get a little bit more volatile, it would, since now it's looking like it's getting more volatile after an election, it's like you want to make weekly income. You use monthly trades to make weekly income, but I would do a weekly trade to see if I can make money in the next few days. And I would do that using either the SPX or using the spiders. And I like the SPX when I'm doing this because you can't get assigned. So if I were to do this, I would be looking at Monday or Tuesday where, shit hit fan. You're going to see this thing being priced a lot, no doubt about it, because it is. But you see it again. It's definitely priced more after, but it's ridiculously priced more like 2 weeks after. The week after, no, right after their so-called election, it's insane. It jumps from 90 at the day of their so-called election to just a week later, 6 days later, it's damn near double. I like that. So if I were to sell, the thing is, if I were to sell the November 5th, November 4th, let's see where the 5th and the 4th are at. Damn near the same. Wait, no, I'm at the wrong month. There's 5th and the 4th. Yep. They're only $7 over. So if I sold the craziness that's happening on their election, sold those puts, and bought the 58.30, it would cost me a lot of money to do it because the 58.30, if I did it, no, if I went, the further you go out, the more you have to pay. That 16, I was going to go 6 days out to November 20th and see what would happen if I bought it. Yeah, it's just a ridiculous amount of money. I'm thinking if I look at it like this, and I think you're getting $100 a day on Theta. It's a $4,300 trade. Do I want to type $4,300? No. But I do like the fact that you're getting paid. This is just a regular calendar. It's directional, so it could hurt you. But if you really wanted to play this kind of, you would say, what is the expected move on this particular thing? I would do it a lot tighter. Like I said, that would be for weekly income. You'd do it it would be daily income, but you're out a few weeks. But if I wanted something that's shorter, what if I did this? I went in day after their election. We'll go 2 days out, bought that. But instead of buying it at the money, we know that this thing is more than likely going to move $145. You're at 58.30. Chances are, that the expected move is $145 out. So that gives you some room to be right. So 58.30, we went down to 58. And I'm going to say, again, the probability of this thing, they're saying, if I went down to 30, say 33 deltas, it's a 66% chance that this thing is going to get touched. That's all you care about. is for that market to touch that area. It doesn't have to land there and you end there. You just want it to touch that area. That gives you 66% chance because that's double your delta. And it's within that $145 that they expect it to fall. And when markets fall, they get more volatile. So the volatility that this one will go up in price as it goes down. Day after election. If I sold the November 4th, so that's 5 days, what would happen if I sold the 57.55 and November 4th, I bought the 57.55. I mean, I sold the 57.55 in November 4th and bought it on the 9th. What would happen? So that's $2,500. You are 8 deltas long, so you are long. You're getting paid $78 a day in theta. It is very expensive. So if I did this in spiders, it would be $256. Same thing. But the thing that I'm looking at, I could do this instead of November 4th. Let's delete this. Let's make it even tighter. Again, this is like a fast money trade. We'll go, you're buying the 7th, 9 days out, and you're selling the 5th, 7 days. 57.55, 2,200. I don't really want to spend, but you're getting more in theta. I'll do like that. So if I did this trade in spiders, which we'll look at this, doing this in the spiders, or you could go, no, actually they won't, Thinkorswim won't let you do it. You could try to do it on the mini. You could do it on the futures, the mini, or the micro. I think Tasty will allow you to do a calendar trade on the micro, which is even cheaper, costs you $22. But what my thinking is if this market goes down, if it goes like seriously, ridiculously down, then I mean, it's crazy. It's a crazy trade. The micro index doesn't have a lot of volatility, but it would be a fun thing to try just to experiment with, because I would only I would have to stay in this trade between now and then. Looking at volatility, I would be in this trade probably between the 7th up to the 7th, between now and the 7th. Man, what is that? That's like 9 days. I'd only be in this trade for like 3 days. 3 days they expected to move $34. No, in 3 days they expect this thing to move $74. So if this thing went $74 down, volatility would probably go up like 1%. So if it moved down to 74, again, this is a bearish move. It's speculative. It's buying volatility. You want this market to at least go down a little bit. This is where you want him to get on top of the hill. So if he falls where he's at from right now to where getting on the top of the hill is where you want him. But you want him on the top of the hill by around that time, by expiration. So if we analyze this and say, well, what if this thing, remember, we want to be out of this thing in like maybe 4 days. We want to be out of this by, say, by the 1st. Say the 4th at the latest, but by the 3rd. I mean, by the 1st. Want to be out of this trade by the 1st. That's a $73 expected move. So if this thing moved, analyzing this, we're going to put it on the 1st. Oops. So on the 1st, if this thing stays where it's at, we'd be down. If it moves down to that price of, where's that price? At 57.55. Let's just say it moves, instead of 57.55, it moves to 5,800. What would happen if it moved down 27? Okay, we'd only be down $95. That's with volatility staying the same, not moving up or down, just volatility staying the exact same. If volatility goes up 1%, which it normally does, when markets go down, volatility goes up. If we went to, okay, that would be the 1105. Okay, we should be making more as volatility goes up. Oh no, this is a calendar. We would like no, actually you want volatility to go up as a calendar. So I'm not using per IV contract. I could use that. But if volatility went down, interesting. Our Theo would be going through the roof. That's interesting because you want volatility to go up as a calendar trade. It's showing us that we would be losing. Should volatility go up a point? Oh no, that's the first contract. I'm sorry, I'm looking at the other contract. If volatility went up on this contract, yeah, we'd be up because volatility. If it went up on our back month contract, yeah, we would definitely be up. We were looking volatility to be sucked out of the front month contract. Then we would be up quite a bit. We would be doing really, really well. That's if that's the case. If that's the case. So I'm thinking about I don't think we could make this on the, because I would like to experiment with this on the XSP because I don't want to get assigned on anything. XSP, and I'm gonna see if they'll allow it. So it was a 557 or 557.55. So that would be the 575 or the 57.75. We're doing November 1st, November 5th. So 575, because this thing 57.75. Let's just double check that. SPX 575 is what we're looking for on the XSP. So let's see if we can do that. I don't think we're going to find liquidity to do this with. But what if the 575, that's down at our expected move. That's because they're expecting from 582, they're expecting this thing to move $7 between now and then. So we'll go 576. That's a 24 delta, which means that's a 48% chance. No, we're going to go, I want a better chance. So I'm going to go 578, 19% volatility, sell that on the November 1st and buy the November 5th. Let's see. No, by the November 7th. Yeah, November 5th. So we sold this one. No, November 5th, that would be the 7th. This is really a gamble because, you got the election. So we're looking at a $240 trade. You're getting paid $23 a day. Wait a minute, that's 583. My bad, wrong one. I'm doing a diagonal there. So if I did the 578, it'd be a $68 trade. You're getting paid, wow, wait a minute, $68 and you're getting paid $23 a day? There's something wrong with this. Let's do that. Getting paid 23 cents a day on a $68 trade. What is the implied? That's 15 on the one you're buying. And let's go with the one we're selling. What is the implied of the one we're selling? The one we're selling is 19. Wow. Look at that implied volatility. You are definitely doing, this is a gamble. This is a major gamble trade. This is a serious gamble, thinking that markets will fall between now and then. This is a huge gamble, but it's only 68 cents. Your two deltas long. This is only a 68-cent trade. It is a bearish calendar. Let's look at the hill. But you're making $23 a day on Theta? Man, that's crazy. I wonder if they'll allow it. It could be because there's no volume. Because that would be the only thing, is there's no contracts there. Again, this is not a very liquid security. Yeah, there's no volume. You got, 2-3 contracts there on November. And do you have any on November 5th? You got 4 contracts there. There's really no volume. But it's just cool to see that. So I'm wondering what the mountain would look like. Again, it's a bearish trade. You're buying volatility. But I'm just like, damn. They're saying it could get down below this to the 575. But my thing is like, I mean, the theta is good. The gamma's not. I mean, the delta and gamma are not going to. I mean, it's for what you're getting, the gamma could your delta you are paying for the delta $2, but I'm just like, this is cool. I mean, it's a cool looking trade. It is a very cool looking trade. This market could go against you, and as it goes against you, you are going to be losing on the delta. But that theta, that something's got to be wrong. You can't be making that much theta. You cannot be making that much theta on this trade. I'm gonna see if the market will come to me. If it does, then that's gonna be interesting. On a 65-cent trade, getting 20 cents a day in theta is pretty intense. That could change tomorrow. You could be losing 20, because the volatility can suck out of this tomorrow. But I'm gonna put this on. I'll put that trade on and see what happens. And then I'll start adjusting the ones that I didn't get filled with just to see what happens. Did I get filled? No, I didn't get filled with IWM yet. Okay, 144, 150 credit, 144. That's all I'm getting? Dang. I'm glad I took the other one off. So we're going to go down to 149. Because I want this trade, but not that much on this iron condor. We'll go to 148. I want it, but not that much. It was more important to get out before non-farm payrolls and elections than to get in and gamble on that one. But I'm gonna leave that other trade on. I'm gonna leave it on. The TLT where we at on that's still nowhere. There's no contracts. Somebody's not wanting to trade it. But this other one is kind of cool. Now, I got it at mid price of 65, and if it doesn't move around too much, I'll go up to 66 just to fill it, just to gamble. That's a gamble. That's rolling the dice. Buying volatility is mostly a gamble. Very cool. Anyways, it gives you kind of an idea of what I'm looking at. I like that 23 cents a day in theta. That's ridiculous. Anyways, I'll leave you guys hanging. Just think about it. Why would markets do that 2 weeks out of an election? I know exactly why. And it's very geopolitical. It's very political, extremely political. Why something like that would happen. Think about it. Y'all take care. Hotep.